Welcome to The Explainer. So today we're setting the stage for a deep dive into an area of the financial world that honestly used to be locked away behind closed institutional doors. We're talking about Indian government securities. We're going to break down exactly what they are, the very real risks involved, and how you can actually step in and buy them directly. I am super thrilled to guide you through this whole shebang, so let's get started.
When we think about investing our hard-earned cash, our minds almost automatically jump to the usual suspects, right? Fixed deposits, mutual funds, gold, maybe the stock market. But I want you to imagine something a little different for a second. What if you could just bypass those traditional routes entirely? What if you could lend your money directly to the government of India or even your state government, and in return, get a fixed interest rate for a set period? Well, that is the core idea behind government securities, and today we're unpacking exactly how this works for everyday investors like us. Here's our quick roadmap for today. We'll cover 1. What are government securities? 2. Types of government securities. 3. Features and key risks. 4. G-Secs versus fixed deposits. And 5. How to invest directly.
Section 1. What are government securities?
Okay, let's dive into this. A government security, often called a G-Sec or just a government bond, is basically the ultimate sovereign-backed promise in the domestic market. Think of it this way. When the government needs to fund, say, massive infrastructure, public services, or big development projects, it has a couple of options. Instead of relying solely on taxing the public to the brim, the government borrows money directly from investors. In return, they hand you this security. You provide the capital, and the government promises to pay you back based on very specific, strict terms. The principal amount is generally repaid when the bond matures, and depending on the exact instrument, you might also get periodic interest payments. It's essentially a direct, legally binding loan from you to the state.
Section 2. Types of government securities. So there are 4 main flavors of government borrowing available to you. First up are Treasury bills, or T-bills. Now these are short-term securities issued for 91, 182, or 364 days. They're actually pretty unique because they don't pay regular interest. Instead, they're issued at a discount. Say you buy a T-bill for 9,700 rupees, you'll receive its full face value of 10,000 rupees at maturity, and that difference, that's your return. Second, we have dated government securities. These are your medium to long-term bonds maturing in 5, 10, 20 years or even longer, and these do pay a fixed interest amount, which we call a coupon, at regular intervals. Third are state development loans, or SDLs. These are simply securities issued by state governments, and they sometimes offer slightly different yields to attract capital. And finally, floating rate savings bonds, where the interest rate isn't permanently locked in, but is actually linked to a benchmark that changes over time.
Section 3. Features and key risks. And this brilliantly illustrates how G-Secs act as a powerful fixed income diversifier within your broader portfolio. Because central government securities are fully backed by the government of India, they carry an incredibly low credit risk in the domestic market. For an investor who already has a lot of exposure to wild, volatile equities, adding a structured slice of government securities balances out the risk beautifully. It acts like a reliable anchor. Though, of course, that always depends on your own individual financial goals and your overall investment horizon.
Now listen closely, because here is the single biggest misconception out there. Low credit risk does not mean zero investment risk. Let me repeat that. It doesn't mean zero risk. Yes, the government backing practically guarantees that if you hold the bond until its exact maturity date, you are absolutely going to get your principal and your promised interest. But these securities are highly tradable in the secondary market. If you suddenly need to sell your bond before it matures, the market price on that particular day might be higher or lower than what you originally paid for it. The payout at maturity is guaranteed. The daily market price is absolutely not.
So the main driver behind that daily price fluctuation is what we call interest rate risk. Bond prices generally move in the exact opposite direction to interest rates. It's literally like a seesaw. Imagine you're holding a bond paying a 7% coupon. If market interest rates suddenly shoot up and brand new bonds are being issued paying 8%, well, your older 7% bond instantly becomes a lot less attractive to buyers, right? Because of this, its market price will drop to compensate for that lower yield. And keep in mind, longer duration bonds are especially sensitive to these shifts. The longer you have until maturity, the steeper the potential price volatility.
Beyond just interest rate risk, there are a few other realities of bond investing we need to quickly touch on so you have the full picture. There's market price risk, which we actually just covered. That's the potential of losing some capital if you have to sell early. Then there's reinvestment risk. If interest rates fall, those periodic coupon payments you're getting might have to be reinvested at the new, lower rates, which kind of drags down your compounded returns over time.
We also have inflation risk, meaning even if your returns are perfectly steady, high inflation might slowly eat away at your actual purchasing power. And finally, liquidity risk. Look, unlike massive blue-chip stocks, some government securities might have lower trading volume. That just means you might not be able to sell them instantly at the exact price you want.
Section 4. G-SECs versus fixed deposits.
So the crucial point is this. A government security is not just some fancy government-issued fixed deposit. They are fundamentally different instruments. When it comes to safety, G-SECs are sovereign-backed, while your FDs are backed by your commercial bank and insured up to a specific limit. But check out price volatility. FDs have absolutely zero. Your principal stays completely constant. G-SECs, on the other hand, because they're actively traded on the open market, will absolutely see their prices fluctuate daily. And what if you need your money back before maturity? Well, with an FD, you usually just pay a straightforward, predetermined penalty fee to the bank to break it. But with a G-SEC, your exit value depends entirely on the current market price, which could result in a capital loss or, hey, even a capital gain.
Section 5. How to invest directly.
Thankfully, the Reserve Bank of India has made this whole process incredibly seamless for retail investors through their RBI Retail Direct platform. Here's the step-by-step journey. First, you'll visit the official RBI Retail Direct portal. Next, you register and open a Retail Direct Gilt, or RDG account. You'll just need standard details like your PAN, email, and your savings bank account, all authenticated via a quick OTP. Step 3 is knocking out your KYC, which the portal handles really smoothly through CKYC or Video KYC. Step 4, you choose your investment route. And Step 5, you make your payment via that linked bank account. And honestly, the best part? The RBI provides this account opening and maintenance facility with absolutely zero fees. None. It's literally a direct, free pipeline to government debt.
When you hit Step 4 and choose your investment route, you're going to see two options on the platform. The primary market is where you participate in non-competitive bidding for brand new securities, buying them directly as the government issues them. You don't even have to stress about specifying the yield or price. The allotment is handled super efficiently via the auction process. Now, the secondary market is where you can buy securities that are already actively trading. If you choose this secondary route, here is a major word of caution. Always, always compare the yield, price, remaining maturity, and liquidity. Never just select a security because its coupon rate looks unusually high, because that almost always reflects underlying market dynamics that you really need to account for.
Now, what's really interesting here is just how accessible this has become. Historically, the bond market was the exclusive playground of commercial banks, massive institutional investors, and ultra-high net worth individuals. But today, through the Retail Direct scheme, the minimum investment amount for Treasury bills, dated G-SECs, and state development loans is generally set at just 10,000 rupees. Now, you should definitely always check the latest auction notifications, since specific conditions can change. But this incredibly low barrier to entry radically democratizes the whole space. It means ordinary retail investors, like you and me, can easily add high-grade, sovereign-backed assets to our long-term portfolios.
And that brings us to the end of our deep dive. We've covered the structural mechanics, the absolute necessity of understanding interest rate and market price risks, and the exact steps to open your zero-fee RDG account. Government securities are a fantastic tool for diversification, but, they aren't automatically the perfect fit for everyone's strategy. It all depends on your specific financial goals, your investment horizon, and your actual need for liquidity. So I want to leave you with this question to really think about. Based on your own risk tolerance and your current portfolio setup, would you prefer government securities, fixed deposits, or debt mutual funds? And why? Take a moment to really assess your own financial strategy. Thanks so much for joining me on this explainer, and keep learning.